Home buyers have seen their borrowing capacity drop by more than a fifth as interest rates climb at the fastest rate they have in 30 years.
Banks and home loan companies are adjusting their entire practices, and that in turn affects you as a customer along with your ability to get a mortgage. So today we're going to be talking about the three major changes that have just happened in this video. You might have seen some of the headlines about borrowers' budgets not going as far with the recent rate rises. So Nathan, can you explain why that is? What has changed to cause this reduction?
Now, the biggest thing that's changed recently is all these rate rises are having effect on your ability to borrow. The banks have something called an interest rate buffer. Effectively, what that means is the actual rate that you get given plus a buffer of 3% is what they assess you on. So as rates have increased 6 times in the last 6 months, that buffer in which they're assessing your application on means that the interest rate they're looking at you is much higher, meaning you can borrow a lot less. This has been a real issue for a lot of borrowers. And I actually had a customer, Isabel, that we got a loan for about 12 months before all the interest rate rises happened. The cash rate at the time was 0.1%. Now, when Isabel got her loan, we lent her $475,000. That was close to her limit at that stage. She had a brilliant deposit, more than 20%, and happy days. She got fixed in 12-month period. Now, fast forward to today, we're looking to refinance. We've seen 6 rate rises in as many months. Her maximum borrowing power is only $400,000. So she's lost $75,000 in borrowing ability due to all these rate rises. And that's none other than the fact that the cash rate has increased. And the banks are now assessing her as if she's got to pay an interest rate in the 7s. When we got her a loan 12 months ago, they're only assessing her on her ability to pay for a mortgage at 5%. So we can see it makes a huge difference on your ability to borrow. Now, Jaden, what can you actually do if you're in Isabel's position, you've got a mortgage, you're trying to refinance, or you're even trying to get into the market and you're finding that the reduced borrowing power is a big issue? What can you actually do? What are some practical tips for our borrowers out there that are wanting to maximize their capacity? If you find these videos useful, do me a little favor and hit that subscribe button below to keep up to date with all things property and finance.
Yeah, so the first one I'd recommend is look at your current credit card limits. So speak with a mortgage broker. Banks and lenders take your credit card, personal loans, any car loans you got at the limit. So you might have a $10,000 credit card with ANZ, for example, but you only ever use $500 a month. You hardly use it. There might be $500 you pay it off straight away, and you think, well, what does it matter? I never actually used the $10,000. Unfortunately, the banks look at things really conservatively. They say, well, Nathan, you're potentially going to take that whole $10,000 limit, then you're only going to repay it at the minimum at 3% a month. And you can have that credit card for literally years. It could take you to pay off at that minimum repayment. So the banks look at things at a bit of a worst case scenario. So one way to increase your borrowing capacity is look at credit cards, even get a free copy of your credit report. You can get on Equifax or Vita. You can get one a year and see if you've got old credit cards and potentially look to close them and get rid of them. Nathan, I know you had a recent scenario with someone that they had a pre-approval with their existing bank. I think it was ING, and they're probably a bit more conservative than what other banks were, and it actually led to a pretty big uplift in the borrowing capacity.
Definitely. I think this is the second point here, which is shop between the different lenders. So I had Krish, he previously had a pre-approval with ING Bank, whose borrowing power we know on a traditional sense is on the lower side. They were only going to lend him a maximum of $585,000, and he wanted to borrow $650,000. Now, with his pre-approval at ING, we did absolutely everything we could possible, closed credit cards, we closed HECS debts to maximize that ability. But due to the rate rises, once again, that buffer meant that as we did those things, it did increase borrowing power, but then it came back down with interest rate rises. We weren't able to get the magic number he was after. The good thing was we were able to shop around with different lenders and found a lender that was able to lend much more than ING was and secure him a pre-approval with a lender of his choosing. So it pays to shop around with the lenders and work with a mortgage broker here and not get caught up with dealing with one lender only. So that's probably one thing to keep in mind. Shop around between the lenders for sure.
Yeah, so I guess the second point there also is, I know with Krish's situation, different lenders have probably more favorable policies when it comes to income and your sort of employment type. So a pretty common one is, say, with overtime, there's particular lenders that you might get paid overtime is a big part of your job, but a lot of banks might only accept 50% of what you get. So for every dollar you make, they only use 50 cents towards your borrowing capacity, and it can actually reduce your power to borrow. Other lenders will take it at 100%. So that's where, in Krish's case, where Nathan was able to get that extra loan and increase the borrowing capacity. But it can be a common situation, even with income. Not all banks will accept your income. So if you're casual, for example, instead of looking at your income over 52 weeks in a normal year, some banks will say, well, you're casual, you don't technically get annual leave. We're only going to take 46 weeks, and you're going to get a bit of a haircut on your income. It's going to reduce your borrowing capacity and potentially limit what you're able to do. So pretty important things. And like Nathan said, this depends on banks, because there's some banks that are going to be more favorable for investors, some banks that are more favorable for mums and dads. A mortgage broker can definitely help you out with that. The third point, Nathan, I think we were going to cover today was living expenses. So lenders broadly use a household expenditure measure, HEM, as a sort of standard calculation for your living expenses. Obviously, the cost of living has gone up and up and up this year. Fuel prices are up, electricity is up, and it's causing some lenders to be a bit more critical on this. So I know you've had situations where you've been able to sort of work around the banks that have probably a more harsh interpretation of the living expenses. Walk us through that.
I think understanding that every lender has different policies and requirements. We've seen lenders that look at the last 12 months history. They actually do a scrape of your bank statements and look at the last 12 months history of your statements and then say, okay, well, this is the average of your living expenses the last 12 months. This is what we're taking. Now, this can be detrimental to some people in their application because they might have had elevated living expenses for the last 6 of the 12 months. And then they realize, oh, I want to buy a house, and they pull their socks up and they get themselves in a better position over the 6 months preceding. So understanding that not all banks are the same. I had Theo, exact same example. He wanted to purchase his first home. He was gambling a lot. He was spending $1,500 a month on gambling through Sportsbet, TAB, all that sort of stuff. And he decided one day he wanted to buy a house, and he had good, clean account conduct for 3 months. But in the situation where banks look at the last 12 months history, he was going to have absolutely no chance because they were going to average that out to more than $1,000 a month on gambling, which was going to ruin his position and borrowing ability. The good thing is some lenders, and we were able to secure him a loan with a lender that only looked at the last 3 months, who also had a hold on his gambling. So he told his bank he was banking with that he was not permitted to do any transactions with gambling. The bank, for whatever reason, they were able to blacklist it. So he actually physically could not do any gambling whatsoever, even if he wanted to, because he told the bank and they put a hold on his ability to do that. So I think the key here with your expenses is not all banks are the same, and make sure you're working with a lender that's going to look at your situation favorably.
Yeah, I had a similar situation. A question we always get asked is, well, I've got a partner. I'm de facto, but I want to buy my own. I don't want to have my partner on there. And interestingly, the banks are fine with that. But if you apply, if Jaden applies on my own and I have a de facto partner, the bank will assume that I'm covering my partner's ongoing living expenses. Bank assumes I'm paying for their food, electricity, phone expenses, and it reduces your borrowing capacity a lot. So I had another situation with James really recently. Him and his partner were looking at buying a home. He was buying it just in his name because his partner had only just started a self-employed business like in the last sort of 18 months. And a lot of banks just wouldn't consider that income. So they're only looking at James's income on his own. And in that situation, when he spoke to his bank initially, they said, well done, James. You're on about $100,000. You're looking after a de facto partner. Your borrowing capacity is about $350,000. And he's like, that seems weird. His partner's making all this money. They won't consider it. But fortunately, we're able to find a bank that will look at him as long as we can show that his partner's covering living expenses. They call it common debt reducer with some banks, where they kind of cut it in half. That we're able to increase James' borrowing capacity up above 550 to 600,000 and get him the loan he needed. So there's a couple of different ways that banks can assess your living expenses depending on the situation. There's no sort of broad brush method there, but be aware, just because they said no doesn't mean that it's the end of the road. There's mortgage brokers like us, Hunter Galloway, that would love to help out with that and see what can be done in your situation.
I think, guys, the key to remember here with borrowing power, yes, the headlines do say borrowing power is down. It's down 20%. Yes, that has happened. As we talked about earlier, that's due to the fact that rates have risen. The banks have a buffer on the rate that you actually get, which means your borrowing power is subdued. But there is things you can do. As we talked about, reducing credit cards, getting rid of HECS debts, getting rid of liabilities will have a positive impact on your borrowing power. Living expenses. We talked about living expenses. There are things you can do there with working with the right lender. And then lastly, making sure you shop around and don't just take your bank's answer as gospel. There are solutions out there, and this is where we can help. Here at Hunter Galloway, we are mortgage brokers. We deal with people Australia-wide. There's absolutely no cost for the service. We help first homeowners, investors, refinances look to get the best loan possible. And we are mortgage brokers. Call us on 1300 088 065 or visit our website, huntergalloway.com.au. Fill in the free assessment form where we can help, and we'll give you a buzz. Guys, thanks for watching, and we'll see you next time.